Hi, everyone. Welcome to today's webinar session. Good morning. My name is Linda Griffin, Education Programs Coordinator. Some of you will have seen me a few times now because you've attended lots of these sessions, and others I might be new. I'm with BusinessLink and I'm the Education Programs Coordinator. Before we begin today's session, I'm going to conduct a land acknowledgement. We want to acknowledge that in the province of Alberta, we are situated on the traditional territories of Treaty 4, 6, 7, 8, and 10, ancestral homeland of diverse First Nations group, Métis and Indigenous people whose ancestors have walked this land since time immemorial and whose histories, languages, and cultures continue to influence our vibrant community. We pay respects to the Indigenous people of this land, past, present, and future, while recognizing their cultural heritage, beliefs, and relationship to the land on which we reside. Today, we're welcoming back Vanessa Brown, who's been conducting the last few of our webinars here with BusinessLink. Thank you so much, Vanessa, for stopping by once again. And this is one that's quite popular. Today, we're going to be talking about getting money, what lenders and investors want. So Vanessa, feel free to take it away and tell us all about that.
Well, good morning, everyone. My name is Vanessa Brown. I am a CPA, and I've been a CPA since 2003. It's a pleasure to be here with you today. This presentation is here to help you find out what financial and non-financial information is used to evaluate a loan request and what steps you may need to take to prepare for a presentation to the lenders. We have about an hour or so together today. You will receive a copy of the presentation from Linda. This session is designed to be a bit interactive, so if you would like to ask questions, please ask them in the Q&A box. I'm also, on my next slide, going to ask for a little bit of information about you, and I will do my best to read through it as I am presenting so that I may be able to provide some industry-specific examples. We will have a bit of time at the end also to cover questions. So in the chat box, if you could please enter these 4 things to give me a little bit of information about you. So what's the size of the business that you're in, or stage of the business? Is a startup? Has been operating for 10 years? Do you have 100 employees? Do you have 5 employees? That kind of information. Tell me what your role in the business is, what industry you're in, and what you would like to learn from this session. I'll just leave that up for a second while everybody has an opportunity to answer. Hey, so some of the questions that people ask about getting money is, why will I need to get any additional financing capital? Why do I even need to ask for that? Why do I need to have an operating line of credit that maybe is twice as much as what I needed, or what I think I need today? What are some typical sources of financing? What are the advantages and disadvantages of each of those types of financing? And how are lenders and investors different? And why do I need a business plan? And why do I need one? And then how do I make one? What are the leverage ratios that I should use, and how should I use them? How do you evaluate them on a regular basis? And how do those leverage ratios vary between business types? To understand that. And then how do lenders look at my business? So first off, let's just talk about the 5 C's of credit. Virtually all creditors use some version of this. So the first one is character. So what is your reputation as a borrower? And this, if you are a small business owner, this is where they will look at your personal credit history. If you're just starting up, if you've been a business owner for quite some time, they'll take a look at the credit history of your businesses that you've had. They'll look at your capacity. What is your ability to repay the loan? So how profitable is the business? Has it been around for a while? If you are a startup, they will also look at your personal asset base and how that can support the loan. Then there's the capital. What is your commitment to the business? How much of your own money are you putting into the business? collateral is the ability to secure the loan. That's your asset. So if you're doing a loan for equipment or a loan for a vehicle purchase, you have collateral. Maybe you're doing a loan for a building to do some manufacturing. That building is the collateral. That secures the loan. If the loan failed, if you failed on making a payment, they have the opportunity to make a claim on assets of the business. And the last one are the conditions. So what are the terms of the loan that you want? How much money is it? How long to repay? What's the interest rate? What's the payment terms? Is it interest only? Is it principal and interest? Those are all those conditions. So, what are the additional, or why would you need additional financing and capital? This goes back to the question I was asking on the first slide is, maybe maybe it's recommended that I get a line of credit that's double what I think I need right now. And there's a number of reasons to do that, because you want to have access to finance when you need it inside your business. So it is very typical for me to see businesses that have the capacity to borrow much more than they actually are borrowing. And that there's some really good reasons for that too, because when a company has exceeded more than 75% of their maximum credit for 6 months or more, the credit rating of that business can be reduced. So you always want to have access to more financing than what you are actually using. That's personal or business, but especially on the business side of things. And so, maybe you're in the business, third year, and you want to do some sales growth. In order to do sales growth, you might have to stock up on inventory. The second point on that one, you might need to hire some people, pay them for 2 or 3 months before you even get your first sale under that new sales growth plan. So you need this financing to help you get to ramp up the business. Third reason why is you might need to expand your facilities, and again, if you're going to do sales growth, it's typical that you also need staff. So all of these things require some kind of financing, temporary or even long-term. If it's capital, if it's these facilities expansion, you'll definitely need capital more for the long term. And you might be even getting a 25-year loan for something like that. And the key to getting any of this financing is convincing the investor or the banker that the investment that you're making is going to profitably pay back that investor. So creating a sales forecast, if you're expanding your sales growth, creating a plan and knowing what your cost to expand that facility is going to be, how much it's going to cost you each year, and where those extra sales are going to come from, or how this facility is going to get you those extra sales. So it's all of it. If you can demonstrate that through some good forecasts, that will convince the investor. I guess one other reason why you might need financing, especially an operating line of credit, is that you have a mismatch between revenues and expenses. That goes to my point on the sales growth, where you need to maybe hire some people and pay them for 2 or 3 months before you start to get the revenue. Another example is if you are in an industry where you receive your money at the end, say you are in a real estate building where the person has only the obligation to pay up to 10, you have an obligation to not bill them the last 10% until you're completely done. So you've incurred all the expenses, you've got everything in there, and then you're going to receive money, 2 to 3 months after the work is done. It's that type of thing where the revenue is going to come in after the expenses. You will need financing for that. So what are some typical sources of financing, and how would we rank them in terms of the ease to get? I'm just going to pop up this other document that will come out to you separate from the PowerPoints. So here are 5 of the main sources of financing. And, the question is, rank these from the easiest source to the toughest source. So family and friends, that's going to be your easiest source. Then getting unsecured borrowing, including credit cards. Then your next one would be more the banks and credit unions, where you're getting probably some kind of a secured or a bigger loan, some kind of a bigger loan. You can then go to government programs and venture capital firms. With venture capital firms, you usually end up with significant additional reporting after the fact. And so those ones are, number one, harder to get up front, and also number two, a little bit more difficult to do the reporting on them. Let me just talk a little bit more about the family and friends. Family and friends typically are the first source that I see with small business growth. This is from the owner of the company, maybe the spouse of the owner, and possibly some parents or siblings or some really close friends. Oftentimes the investments are made on a handshake, and I as an accounting professional advising my clients and being asked about these financing arrangements, always recommend that the individual go to a lawyer and get that documented and make that loan like a third-party loan. So there are clear terms of repayment. And it's important too, because if it's only 1 or 2 family members out of 6 to 8 family members that are contributing to the business, there can be some estate implications based on that borrowing. And so we want to make sure that it's documented, and it should be to the same standard as if it was a third-party loan. If it's in one downside of borrowing from family and friends is if the business doesn't take off the way you hope, then you might end up with a lifetime of bad family relationships. So just always be evaluating those types of things. And if you are the shareholder and you invest in a corporation, so again, I want to clarify, this is investing in a corporation and not just creating a sole proprietorship, you can get a tax benefit from an allowable business investment loss if the business did not go well, meaning that whatever money you advanced to the company that you did not get to pay yourself back, you can claim as a capital loss on your tax return. The unsecured borrowing is relatively easy to obtain. I typically see, easily $25,000 offered up to a business with no questions asked. Just, here you go ahead, get started. The downside on the unsecured borrowing is that the interest rates will be a bit higher. So our Bank of Canada rate right now is 5%. Typically seeing unsecured borrowing at some range of about 7 to 10%, depending on the person's borrowing history, the business owner's borrowing history. The banks and credit unions are typically third source financing. These require extensive documentation about the ability of the owners to pay back the money. So this is where you would definitely need a business plan. If you are investing in some capital that will generate sales revenue in the future, you'll have to have done some projections on how long that equipment will last, what the repairs and maintenance cost will be, and what your anticipated capacity is, and then incorporate all of that information into your sales forecasting in the business plan. Government programs are another source of financing. We've seen lots of that in the last 4 years. It usually involves presenting an application. Some of the more extensive granting programs some industries get access to more grants than others. Some I can think of are the arts industry. We also see that in sort of research and development firms. There's quite a bit of dollars out, quite a number of dollars out there under the government grant programs. You fill out an extensive application. You might have to also have that business plan and your forecasts in there as well. The venture capital firms, they're last in line typically. These organizations require substantially higher levels of commitment by the business owners and the investors to achieve the business goals, meaning that if you are asking them for 200,000, that you have to advance your own 200,000 before they'll grant any of the money to you. And they will act a lot more like a partner. They might even dictate how you do your business operations. And as I mentioned earlier, have a lot more financial reporting requirements in the long run. Okay, so what are the differences between lenders and investors? So a lender, all of those, unsecured and secured and, bank loans, the longer term bank loans that I was referring to, those are all lenders that are giving your business money. And so they will give you some money based on some terms and conditions that you make payments on a regular basis, that you pay a certain amount of interest, that you're paying back a certain amount of principal over a period of time. They won't even get involved in your business. All they care about is getting their money back. And they might have some periodic reports and meetings with you. They might ask you to put in your annual financial statements, maybe quarterly, occasionally. Well, it'll depend on how much you've borrowed from them. If you've borrowed over 250,000, they'll usually require monthly financial statements and monthly inventory reports on that as well. And then they'll have meetings with you. Investors, on the other hand, will become a bit more like a partner. They are either buying into some preferred or common shares of your business. They might be intrusive, but their experience and knowledge may be useful. So if when we look at, say, the popularized shows of Dragon's Den or Shark Tank, when those investors offer up their talent to help you with your business, they want to become a part owner, and they want certain returns that come out of that. But they also advance a lot of marketing expertise and advance a lot of business knowledge and how to do business analysis. And they've got extensive experience that way. And they can also trigger some really painful provisions if performance targets are not hit. These are all contractually agreed to up front. So this is it, you want to have lots and lots of conversation up front before you actually sign on with an investor, and make sure that you understand all of the business risks that's associated with signing them on. So going back to the 5 C's of credit, the first one being character. Here's some more details on how they evaluate the character of the borrower. First, they look at your credit scores, both from previous business, if you've had one, and also your personal credit score. They'll ask and wonder about how experienced you are in the business of what it is that you're doing, what you're selling. They will ask your experience with the lending institution, or they'll, if you are asking for a loan from a creditor that you have worked with for 10 years already, they already know your character. If you are moving from one institution to another, then they don't have as much information about you. And so they may give you a higher rent. I say may, because I often see my clients move from one lender to another because of preferential lending terms at the other creditor. Your character was also dependent on your reputation in the community. What does that look like? And your relationship with the lending officer. Have you maintained good communication with them? How has that gone? Do you get along well, et cetera, et cetera. The second C was capacity. So whether or not the business actually has capacity to do the borrowing and make payments back. So this is done typically through some form of ratio analysis, and this is where we're going to go through many of these ratios so that you can understand what types of things you need to manage as a business owner. So the first category of ratios are liquidity ratios. How liquid is the business? How easy is it for the business to make repayment on those loans? So we have a current ratio, a quick ratio, and then a one-time horizon ratio. Sorry, that's not what it meant by that. But it's a it's a 1 year time horizon for both the current and the quick ratio. And we have a leverage ratio, several leverage ratios. Debt to equity, we have interest coverage. So how easy is it for the business to cover the interest cost? Can they repay that interest cost on a regular basis? And then we also have a fixed payment coverage ratio, which would incorporate any fixed lease agreements that you have. So on top of your borrowing payments, anything else that you've committed, the business is committed to pay on a regular monthly basis. The first one is the current ratio. We have current assets divided by current liabilities. So does the business have adequate liquidity? This is the question we're asking. And so, if current assets are 100, I'll use the example here. We've got 150,000 of current assets, and we've got 100,000 of current liabilities. That means we have $50,000 more in assets than our current obligations to pay off liabilities. And that's a 1.5 current ratio. We always want that ratio to be 1 or more. And in some industries, that might need to be more along the lines of 2 or 3. But anytime we're below 1, what that means is that our current assets are less than the liabilities, which is problematic. It means how are we going to repay all of the liabilities? And your lender may specify right in the agreement what they expect to see. If it's one of those smaller loans that I mentioned that they just grant, they don't specify any kind of liquidity ratio or any requirement that way. It's just with the bigger loans and the monthly and quarterly reporting, you would end up having to report that information on a regular basis. So another liquidity ratio is the quick ratio. So the difference here is you take current assets minus the inventory. We take inventory out because it's not maybe liquid, and it usually is not as liquid as cash accounts receivable. And so we remove it. And then again, if that ratio is less than 1, there may be a liquidity problem. And you would need to check with the banking institution to find out whether or not, what they expect. It might be higher than 1 that they expect. In our example, we have the 150,000 in current assets minus a $40,000 inventory divided by the 100, and we end up with a 1.1 quick ratio. Now, getting into our leverage ratios, this is measuring how leveraged the business is, how much debt there is in relation to retained earnings and share capital that the shareholder has purchased. Capital intensive businesses will usually have a higher ratio, meaning that the liabilities they carry will be greater in proportion to their owner's equity. And lenders usually want 2 or lower. They want this, again, because liabilities is the numerator on this equation. They want that leverage ratio to be lower than, not higher. In this example here, we've got 200,000 in loans. We've got 100,000 that was invested by the owner. And by invested, that is the combination of share capital, the original purchase of shares that the owner made from the company, and the earnings that have been retained in the company over time. So if the business has been operating for a while, that retained earnings number is the net income each year, cumulative. So in this example, our debt to equity ratio is the 2, and it definitely meets all requirements. Another leverage ratio is that interest coverage. We want to take a look at how able the business is to pay the interest cost. A lot of line of credit facilities will require only the interest to be repaid. So these are good for startups where all of the money is going into the capital and the people and, getting everything up and running without the commensurate sales and when you're growing those sales. So we calculate it by dividing the operating profit by interest payments. In our example, we have an operating profit of $9,167 and $750 of interest payments. So we have a 12.2 interest coverage ratio. The fixed payment coverage takes that operating profit and adds back the asset lease payments that have been expensed. Because operating profit is revenue minus expenses. The expenses that were included to calculate the operating profit included those lease payments. So now we add the lease payments back. The denominator is now interest plus the principal. So not just the interest on its own, but the principal and also the asset lease payments. And the question we're asking, the question that's being answered actually by this leverage ratio is, can profits cover the lease payments? And so numerically, if we had $7,167 of operating profit, and we add back the lease payments, and we have a $2,750 loan, and we add back lease payments, we end up with a 2.6 coverage ratio, which is better than this 2. That's the usual standard. But again, it depends on the industry you're in as to what that leverage ratio needs to be. So leverage ratios, I keep referring to this, can be different in different industries, could be different requirements by the bank. For some companies, the maximum acceptable debt to equity ratio is 2. The average debt to equity ratio is usually 1.5, and the capital intensive industries will usually have a debt to equity ratio above 2. And that would be the capital intensive. That's because the borrowing is secured by the asset. So the bank is willing to accept a higher debt to equity ratio, knowing that if something failed, they can recoup by making a claim on the asset, taking the asset and selling it to someone else and getting their money back. The third C of credit is capital. So how much money is the owner going to invest in the business? Another way of saying that is how well capitalized is your business? Do you have enough capital to withstand some losses if some kind of a loss happened? So the equity ratio is one measure of that. We would take the capital stock plus the earnings retained over time in the business divided by total assets. The fourth C of credit is collateral. And collateral is the property that will be seized if the loan payments are not made as agreed. So a lien gets placed on the collateral to incentivize the borrower to make payments. So that they will register on the title of that property a lien so that you can't sell that to somebody else without first paying the bank back. The lien does these 3 things: incentivize you to make payments back, it reduces the risk of extending the credit because they can take the asset back, and it limits their loan losses. And loan to value ratios vary. They're typically around 65%. I would say that 65% is more on the equipment side. When it comes to real estate, they will generally allow borrowing up to 75% on commercial property. And know this, lenders really don't want to collect the collateral. They really just want you to have a successful business and to pay you as you've agreed to pay them. Here's a few loan conditions. This is the 5th C, the different conditions that they would place on the loan. You're going to have an interest rate that you're going to pay. You will have financing fees at the upfront. And included in some of these fees, I see some really creative things out there with, say, the Business Development Bank, where you pay your fee to get financing, but then you can voluntarily pay some fees to get some consulting. And I'd say their consulting program is quite a reasonable one. They give some good advice. They are quite reasonable in what they charge. They generally charge that fee for 1 year of advising. There will be a time length associated with when that loan will be repaid. Sometimes with an operating line of credit, there's no term on it in any way, shape, or form. But other ones that are financing equipment, they might be 5-year or 10-year. If they're buildings, they might be the traditional 25-year that we see on the housing market as well. There might be a fixed amount over a period of time that you have to repay, like a term loan. That might be a term loan that's financing operations, that can happen, or it might be just a line of credit that's available at any point in time. There might be interest only periods. So what I see in the seasonal businesses, say a golf course, they will have interest only during the winter. And then during the summer, they repay principal, and they repay it generally at the rate that it would have been if it was a 12-month loan, but they do it over the 5 or 6 months that they're actually open and have cash flow. So they've timed the principal repayment with when they're actually making money. So other industries that may have that similar seasonality are farming, are retail, where it's mostly at Christmas. So you can negotiate those terms to have just interest only in the periods where the business doesn't have as much cash flow. There may be something in the agreement that triggers some kind of an acceleration of repayment. So if you have a debt to equity ratio covenant that you've breached, they may say, well, now we can call the entire loan, we can call a percentage of the loan. You have to be aware of what your contractual obligations are when you're signing. So go through that loan with the banker and also with a lawyer. There also might be a trigger to change interest rates. Again, if you're offside on one of those ratios, you might end up with a change to the interest rate. It might get increased. And each one of these terms, I can't say it enough, they're all open to negotiation. So just make sure you know what your agreement is, consider what your cash flow requirements are. And if something's putting you in a tight spot, know that you might be able to renegotiate something different. It might not be on the interest rate, but it might be on the time length, which would require, smaller principal payments. And then these usually have some kind of a term to the agreement where you can go back and renegotiate. So if you're in a startup mode, you might ask for a longer time length. And then when that term is done, I'm thinking long-term financing, where you have, maybe a long-term financing arrangement where all of these interest rates and all of those types of things can change every 5 years. You may renegotiate something different when you're in a different cash flow position. So investor conditions, this is if somebody has invested in your business, typically through the form of shares. They will buy shares and they will usually require some involvement in your firm. They may also require more protections than what you might have done on your own. So life insurance on the key employees to make sure that if something happened to that key employee, that then the business can still carry on. There is the ability to force payouts at special terms. So these in the industry, we can call these shotgun clauses often, so that if the business isn't performing well, that investor can come in and say, I'm going to just buy up all your shares, and this is the price I'm going to buy them up for. And then it's up to you to come up with the money to maybe buy them out. And these are things that you would sign in what is called the unanimous shareholders agreement at the time that the shares are acquired. The other key point is that venture capitalists usually want a higher return on their investments than lenders do. So if your business would be getting a loan for 8%, the venture capitalist might want a 12% or 14% return. All right, a business plan. A business plan is definitely needed on larger loans. It is going to document your mission, vision, all your objectives, how you're going to get there, give some details. It's really key to getting credit. It needs to demonstrate your understanding of the business. You need to, on the financial side, document all of the assumptions that you've put in to making those numbers. So how many units are you going to sell? What price are you going to sell them at? Where are you going to sell them? When do you think those sales will happen? What are the expenses associated with that? Your direct expenses associated with that, the products, the people time, that type of thing. And you need typically a 2 to 5 year, and I'd say it's usually 5 years that they're looking for a forecast in order to get new debt. The key thing is that you need to demonstrate that the cash flow will be adequate to make all of the loan payments back to the bank. So what's the viewpoint from the bankers and the investors? The bankers and investors see you as a profitable customer, somebody who is going to repay all of the loan back to them and give them some interest, knowing that they have that money available to you because of all the people who have invested their money into their bank in terms of in the form of savings, their bank account balances, any investment certificates that they have, some term deposits, that type of thing. So they are making money on your loan in order to pay them off. So they'll see you as this profitable customer or partner. They will also see you as a potential way to lose the capital that they've given you. So if they've given you $25,000, they may be looking at you and saying, we might lose that $25,000. And they will do some research on you, particularly on the larger loans, so that they can manage their risk on advancing that money to you. And again, the key with all of the information that you're providing to them and how you're presenting everything and all of your business ideas, you're just proving that you are this profitable customer and partner, so that they don't have to go and do a whole bunch of extra research on you and that. So I'm done a bit early today. We have a few extra documents that come in there. We've got the glossary of terms and an implementation checklist. I'm just going to bring that implementation checklist across. So when you are going to go get money from the bank, you need to know how much it is that you need. So you have to have that business plan, you have to have an idea, you have to have some projections, know exactly what you need. And make sure that you ask for a little bit more than what you need. Again, that going back to that 75% rule on operating line of credit, you don't want to exceed your operating line of credit, but you don't want to exceed more than 75% of your operating line of credit for more than 6 months. Develop some kind of a plan for contacting any sources of capital. So if you've got a great business idea and you want to take it forward, you want to develop your plan on how you're going to contact people to get that. Develop your own opinion on how you're going to address all of those 5 C's of character and capacity and that. And then you do want to calculate the ratios that the lenders typically look at. So if you have been, apologies, I'm just going to put that back up. If you've been, oops, if you've been, yeah, make sure you calculate, if your business has been in place for a while, make sure you calculate those ratios. Some other resources that are linked into this presentation are the BDC, How to Get a Business Loan book, and also a video of how that goes along with that. The BDC also has a lot of other resources for writing business plans in that. And I'll just check in and see if there's any questions.
Curious on the call today, who is actively seeking funding for their business? Do we have anyone who's in the growth stage of their business actively seeking funding, and anyone in startup who's actively seeking funding? Maybe you can let us know in chat what your stage is and what stage of funding you are at. You know, it's one of the key skill sets of a business owner. We often think about the business that we do as the stuff we do to get the product to the customer. Like, oh, hi, customer, this is the thing we build, and this is the thing we service, and this is the thing we do. But a lot of the work for a business owner is really the stuff like this, believe it or not, behind the scenes, where you're trying to, especially in the growth stage, trying to remove yourself from the day-to-day and start to work with your advisors to get to the how do we grow, because often with growth, you are hitting that really difficult period of, I have enough customers that I can grow, but I don't have enough money to service those customers through growth and to bring on more growth because I don't have people and I don't have the money for that. I need to supply myself with that. So we have Cassandra who says startup funding. So what are your thoughts on startup, Vanessa? I mean, we know that it's difficult to get startup. What are some of your tips on startup funding?
Well, the first one is if you're currently an employee and looking to start up a business, I would go and get some lines of credit opened up while you're still working, because you can use your employment income as justification, and then you can go ahead and take that and run with it. Beyond that, you really are looking at doing that business plan. Some of the good examples that I have from my past is, a little patisserie shop. The husband had all of the expertise in making all the pastries. He knew that industry super well, and the wife knew a bit of marketing, so she was going to do a large chunk of the marketing. And they developed this business plan that was very well grounded. They knew exactly what their capacity was for the equipment they were acquiring. It all goes down to, you better know all of your costs and where you think that revenue is going to come from. And in this example, they needed $200,000 for equipment, to acquire the equipment, and they had determined what the capacity of that equipment was. So they knew they could make, I'm just pulling numbers out of the air, but they knew they could make 3,000 pastries a day. And then they made projections that were more in the range of 30% of that capacity as their sales volume by month 6, right? Because they had to have some time to go out, make some of these pastries, give them away for free to get people on side, and then had these people buying. And it was a frozen pastry model, so they were selling to other businesses such as hotels and catering companies that they wanted the option to have pastries, but they didn't and to have fresh pastries, but they didn't want to have somebody that was a pastry chef on staff. The key to all of this was they made reasonable projections. They knew their capacity. They made projections that were lower than their capacities. They knew all their fixed costs, and they put them all together in a plan. They knew what kind of cash flow was going to come out of that. So we knew what the monthly revenues and expenses were, and then how the cash would flow from that. So if they were, for the most part, the sales were cash sales, but for the business model side of things, it was usually 10 to 15 days after they did a delivery before they were going to receive the cash from that. And so we had to, make sure that we had that they would have the financing to cover that 15-day delay. So I can't reiterate enough. It's knowing what your numbers are and having some very reasonable assumptions on the revenue side. With them only being at 30% capacity at 6 months, they actually exceeded that because their marketing efforts were well received. And so they had this, I can talk about this business too, because they wound that business up. They made enough money in the business that they could move to France. So it was a fun experience. Yeah. Linda, do you have additional insights on that? Anything on the startup side?
Yes, I think what a lot of people may not understand on the startup side is that your business itself doesn't have any sort of history. So the lenders you're going to aren't lending to your business. They actually probably don't really care at that stage. Just to be frank, you can walk into a bank and you can say, this is the lovely thing I'm starting and the wonderful thing I'm doing, but they're not looking at that at all. They're looking at you personally to lend to you personally and to seize your personal assets if you cannot pay it back, and what is your status. So I loved that you said to folks, if you're currently employed, try to line up your lines of credit and try to line up your sort of emergency start fund and everything else that you can do already before you just quit your job, if you've got one already, and dive right in, because that's going to be your stash. It really is. It's going to be your personal stash, and you're being lent to at that point personally on what your current situation is, and having a employment at that point in time really helps you score some additional lines of credit. Start to build also. Another thing that a lot of people don't think about when they're starting is building the relationship with their banker, not just sort of opening the bank account, walking away and not being involved with their banker and their bank. I can't tell you the number of times my account manager has given me something useful to think about, or led me to some networking events, or led me to other lenders, or talked to me about what they've got going on, or how I can maybe squeeze a little interest out of something or whatever. So don't just walk away from your account manager. Go for coffee once in a while with that person. Like really make that a relationship so that you're always in the know what's going on at your bank. We have someone here who says, how do we know our future numbers if we sell to end customers? Every day is different and we can't predict numbers. Are there any tips to calculate it? How do you know your future numbers?
And I like the question. I think if you're going into business, the key thing is, kind of knowing what what other averages out there. And in this case, I'm going to draw on a bit of my own personal experience. When I started my own accounting practice, I had already been working in another firm, and I knew what in our business, it all comes down to billable hours and our billing rates. And so I knew what my billable hours could be. When I'm running a practice, it's probably 1,200 a year is billable. And even though I'm working more like 16 to 1800 hours in the year, I'm only going to achieve about 1200 because of professional development requirements, vacation, et cetera, et cetera. So I know that's my capacity. And then times that by a reasonable billing rate, which, you know, there's market rates out there to do that. And so that's my capacity. But then I also had my fixed costs that go along with it. Then I could calculate whether or not my capacity could actually cover those fixed costs and pay me a reasonable salary. And so I think you do this in a bit reverse. You know, what costs do you need to incur to get that business up and running and keep it running? So you have initial capital. Maybe your capital is $10,000 that you have to put in for some, you know, a website and some equipment. And then what are your ongoing costs of the business for things like software and phone lines and like cell phones and anything else that might be incurred along the business? Know what those costs are, and then you can calculate how much revenue you need to earn first to break even and then to pay you a reasonable salary. And then that gives you how many widgets you need to sell, or how many hours of service, or how many packages that you need to sell to third parties. And then you ask the question, you know, can I achieve that? And you know, can I achieve that by going out and doing some marketing to people, that kind of thing.
Another way to know your future numbers is to track your past numbers. So track what's happening month over month and start to see if you can see a pattern there. So that's what, you know, your accounting software is for, is to help you track that piece of it. One of the things that happened in my business early on was that we would go through these peaks and valleys, and not quite understand why, you know, why in July was business down so much and in August business was up so much. So we started to do some customer surveying. You know, why are people buying? So don't be scared to do customer surveys. Why are you buying from us? Why, you know, why did you choose us over someone else? How did that work? Also, there's lots of market research you can do. And we do have some at Business Link market research workshops coming up, and that'll help you sort of figure out what you should expect in your industry. If you know your NAICS code and you know what industry you're in, you might be able to see some existing patterns that are sort of industry wide for your industry and what that looks like, and help you sort of make those predictions a little bit better. Any other questions?
I
So
guess
for those,
I would ask Swanson, you know, I saw, I think it's Swanson, you know, do you feel we've helped answer that question for you? And are you able to know what all your expenses are upfront so that you know what revenue you need to earn, and then you can do a reasonable calculation there. This is a startup mode, so it's when you're startup, there's not much history.
those are some of the challenges in year one, right? Here, you're just, sometimes you're running a little blind, and that's no matter how much planning you do, that's just how it is. I'll just be honest. That can just be how it is. You're running a little blind as you're learning the ropes in year one. That's why it's so important to be at these types of webinars. We have lots of workshops at Business Link that we're going to be opening up in November. So if you're subscribed to the newsletter at Business Link, we have a one-page business planning workshop coming up called Bring Your Business to Life. We have market research, business registration basics. We have short videos on our website as well to explore the site, and also explore as we launch our workshops again in November. We have a number of them coming up, including one from Statistics Canada that talks to you about how you can find your industry statistics on StatsCan. Please sign up for some of those. How do you assess numbers when you are pre-revenue? What numbers are you looking for?
Well,
And
cost should be known. You should know how much it's going to cost to run your business and go out and find all that information. And you can have two different models on that, at least two different models. You can go and say, okay, if bare minimum, I need this, this, and this is how much those things cost. And get some estimates, and then there's this act of faith that happens. You can build up some interest in your business before you actually open the doors. And then there's this act of faith of just investing the money in it, and then going out and doing the work and finding the revenue source. And there's a few other resources that I can give you on sort of that business coaching model and that kind of thing. Jody Moore down in the States, she does stuff for a lot of home-based business owners and particularly consultants, that type of thing, about building expectation to receive customers. And there's other local ones here as well. Maybe Linda, some that they're.
there's lots of great resources. Yeah, early on in my entrepreneurial career, and I've had a business now for almost 30 years. I took lots of different courses all the time. I took the Achievers Coaching Program with Les Hewitt, who was big a number of years ago. I don't know if he's still doing Achievers Program. And Build Your Business Library. There are some fabulous books and blogs and resources out there that talk about how do you do a lot of this stuff. Imagine that you are going to school to learn a new profession called entrepreneurship. Go to school with that. So one of the books I highly recommend is anything out of the E-Myth series. And I usually ask people to start with the E-Myth Revisited. And I'll just post that.
That's a newer one. Yeah, that's the newer one of it. It was originally written in 1985 by Michael Gerber. Yeah. It's a really good book. Yep.
He's got some, and if you go to that website, there's some great resources on that website too. So from a purely what's it look like to be an entrepreneur standpoint, how your business looks holistically, that's a great one. From a marketing standpoint, one of his quote unquote disciples, John Jantsch, has started a program called Duct Tape Marketing. That's great for small business owners who are on budgets and want to understand how marketing works and how you apply that in your business. So start to build the library, start to go to events, start to network in the community, join your Chamber of Commerce. One of the things I've noticed in the last 10 years or so is we're less and less community engaged face to face with one another. We've got all this great social media stuff and everything else. But some of the learning that happened for me in my business came from just being connected with other business owners and just sharing stories together. And people from all kinds of industries had all sorts of tips for me in my industry. And it was just a process of sharing together. If you are looking for help directly from BusinessLink, we have 3 programs, one that's going to launch shortly. One is called Guided Startup. It's 5 weeks of one-on-one if you're in pre-start mode with one of our business strategists. They will help you through the process of going through financials, going through some of those things to sort of learn how to think about that. We have another one that is just about to launch called Start Wise. That's going to be our mentor matching program where we match someone in 1 year and under to a mentor, someone who's local in the business community. He will just chat with you for 90 minutes and you can start to make a connection with an experienced business owner who's got 3 and up years worth of business experience. And then we have another program called Peerpreneur, which you can apply to at any point in time if you are 1 year and up in your business. And that's you around a table with a group of other entrepreneurs just like you, sharing stories, sharing best practices. And it's called Peerpreneur, and we open up those cohorts every once in a while. So stay connected in the newsletter with BusinessLink because that's where all that information will come to you from as well. Okay, we're at noon. We've covered a lot. Thank you so much, Vanessa. As always, lots of great information, lots of great stuff. In the next 2 to 3 days, we'll be posting this recording to the website. And moving that forward, you can see it at any point in time. Thanks everyone for dropping in today and taking the time to do that. And Vanessa, thank you again for all of your time and information. Really
Yes,
appreciate it.
thank you as well. Take care.
Take care, everyone.